These days, we often hear about jobs being outsourced or offshored to low-wage workers in distant countries. Why is this happening? Let's find out. To start, look at this chart. Employment is up. That's good. But what about this chart? It shows that the percentage of Americans who are employed is still much lower than before the recession. This is because the population of working-age Americans has grown by roughly 6 million people. The number of jobs has not grown as fast as the population. This is confirmed by the next chart, which shows the percentage of the population that is considered to be in the labor force. To be included in the labor force, a person must be employed or temporarily laid off, or else they must have looked for work actively in the past 4 weeks. If anyone gets discouraged and stops looking for work, they don't count. So even without any new hiring, the official unemployment rate automatically goes down as job seekers get discouraged. The real unemployment rate should probably look more like this. Now let's go back to the increase in jobs since the recession. What kind of jobs are they? This chart shows that on average the new jobs pay less. Part of the reason is that millions of manufacturing jobs have disappeared. So where have all the jobs gone? Well, you may have noticed that most of the products that stores carry these days are made in China. Of course, it's wonderful that millions of Chinese people have been lifted out of poverty. As well, international trade can benefit everyone if it's done fairly. Here's a chart that shows the growth of China's economy. The brown line shows the rate of growth. China has grown so rapidly because the Chinese currency is undervalued. The Chinese currency is known as the yuan or renminbi. This chart shows its value over the past 10 years. The rise in value may look steep, but notice that the yuan has risen from 12 cents to only 16 cents, which is just a 33% increase spread over a decade. On average, that's only 3% per year. Also notice that as of early 2015, the yuan has retreated back to the level it reached in early 2013. The next chart shows one consequence of the undervalued yuan. America imports much more from China than it exports to China. Let's flip the chart so that America's imports are on the bottom. Now you can see this black line below the horizontal axis, and this is the U.S. trade deficit with China. It shows how much more America buys from China than it sells to China. The most recent trade deficit on this chart is $300 billion. To see how this works, let's consider a normal, healthy trading relationship. Here, the value of trade in both directions is roughly equal. That would be good, but it's not the case with the U.S. and China. The actual situation is more like this. Imports into the U.S. dominate, and so huge sums of money are flowing from the U.S. into China year after year. This is happening because the Chinese yuan is undervalued. Thus, Chinese goods are priced very attractively in the USA, whereas American-made goods are too expensive to compete. If this trading relationship were healthy, this imbalance would have quickly corrected itself long ago. Here's how, in simple terms. When Chinese exporters receive U.S. dollars, they take the dollars to the bank and get Chinese yuan instead. They need yuan for running their factories and buying groceries, etc. Now, ideally, the bank would then sell the U.S. dollars in the currency spot market and buy yuan. Selling dollars in huge volumes every day would push down the value of the U.S. currency. Similarly, buying yuan in huge volumes would push up the value of the Chinese currency. The new adjusted exchange rate would make Chinese goods more expensive in the USA, and it would make U.S. goods more attractive in China. Thus, the flow of goods and money between the two countries would become more equal. Unfortunately, the Chinese government has not allowed the yuan to float freely to its equilibrium level in currency markets. Instead, when Chinese exporters bring their U.S. dollars to the bank, it's believed that the People's Bank of China exchanges the dollars with newly created yuan. This is equivalent to printing money. This increases the supply of yuan, which tends to devalue the Chinese currency, or at least prevent it from appreciating. Let's compare the US and Chinese money supply charts. They look quite similar, but there's an important difference. From 2000 to 2013, the US money supply roughly doubled, whereas the Chinese money supply grew by over 900%. This New York Times article agrees that China has been creating a great deal of money to keep the yuan undervalued. By undervaluing the yuan, China is paying its exporters more yuan per dollar than they should actually get. Thus, the PBOC, the People's Bank, is subsidizing Chinese exporters. In fact, export subsidies are prohibited by the World Trade Organization, which China joined in 2001. The undervalued yuan has caused many U.S. manufacturers to move their operations to China. As a result, millions of Americans have lost their jobs. Consequently, the U.S. government has lost income tax revenue, and it has had to increase social safety net payments to unemployed workers. This has only worsened the U.S. government debt. An additional consequence of the undervalued yuan is that other emerging nations are forced to devalue their own currencies as well, just to remain price competitive with China. This has further undermined the American economy. Next, here's a chart showing the U.S. current account deficit, which includes the trade deficit. Notice that each bar represents the deficit for just 1 year. To see the total impact, we need to add all the bars together. If we do that, we can see that the cumulative current account deficit reached almost $9 trillion by 2011. This is economic output that would have been produced in the USA if emerging nations like China had not undervalued their currencies. How big is $9 trillion? It's more than half the size of the entire 2011 US GDP. Now, regarding China's currency manipulation, you may be wondering what the People's Bank of China does with the billions of US dollars it accepts from Chinese exporters. The answer is that mostly they invest them in U.S. government bonds, also known as treasuries. Over the years, China has hoarded an enormous quantity of these bonds. What's the total value of their U.S. bonds? China doesn't reveal that. Actually, the Wall Street Journal has reported that even the U.S. government doesn't know exactly. Here's a table showing their best estimate. Notice that after years of accumulating treasuries, China slightly reduced its holdings in 2014. Perhaps this was to avoid being criticized for hoarding U.S. bonds, which is a sign of currency manipulation. But during the same time period, a Belgian company named Euroclear acquired an unusually large quantity of treasuries. Some experts believe that Euroclear is holding the bonds anonymously on China's behalf. China may have switched to buying American bonds anonymously through Euroclear to continue manipulating the yuan without being noticed. But why would China want to escape notice? Perhaps because U.S. law requires that twice every year, the U.S. Treasury Department must name any countries that are manipulating their currency. Labeling China a currency manipulator would allow Congress to apply tariffs and sanctions against Chinese goods and companies. But despite abundant evidence, the U.S. Treasury Department has never named China as a currency manipulator, whether under George W. Bush or Barack Obama. That's very puzzling. So let's take a quick look at the Treasury Department's Autumn 2014 report, just to see how absurd the situation has become. The report states that, starting in February 2014, the PBOC intervened and pushed the reference rate lower to weaken the RMB. Okay, that's manipulation. The report also says, even while the RMB remained on the weak side of the band, the authorities were acting to limit appreciation pressures. That's manipulation again. The report continues, China has not yet reached a situation in which the RMB exchange rate can be said to be market determined. In other words, China is still manipulating the RMB, also known as the yuan. The report indicates several more times that China is manipulating the yuan, but then in the conclusion, the report denies it. It's absolutely astonishing. Now, Why does the Treasury Department's conclusion contradict the facts clearly stated in their own report? By failing to name China a currency manipulator, has the Treasury Department broken U.S. law? Simply by naming China as a currency manipulator, they could have allowed Congress to fix this problem years ago. Actually, a number of very influential people are extremely concerned about America's trade deficit with China. For example, listen to just a few quotes from this strongly worded official report to Congress. It states that the benefits of the U.S.-China trade relationship have accrued disproportionately to U.S. corporations, while most of the drawbacks have been borne by U.S. workers. Congress should urge the administration to begin immediate consultations at the G7 addressing China's currency manipulation. The need for immediate action is also recognized by the Economic Policy Institute. Their February 2014 report states that China has been substantially underreporting its trade and current account surpluses for at least the last 6 years. China's actual surpluses are up to twice as large as those reported by China. The EPI recommends that China's currency manipulation should be considered an illegal subsidy which the U.S. Commerce Department should address with countervailing duties. On the other hand, this report from the Richmond Fed claims that protecting American jobs by charging duties on imported Chinese tires would be unfair to U.S. consumers. What it neglects to mention is that the estimated $1.1 billion in tariffs collected on the tires would help reduce the U.S. government debt, which would benefit all Americans. Also, if the Chinese yuan were fairly valued, American consumers would be paying higher prices for Chinese goods anyway. Unfortunately, China's dictators have strong motivation to continue undervaluing the yuan. If they let it rise, they would lose their price advantage in world trade. And the value of their huge hoard of U.S. bonds would decline in yuan terms, which would be an enormous foreign exchange loss for the Chinese government. Hence, China will not agree voluntarily to raise the yuan. It will cooperate only when the U.S. labels China a currency manipulator and when Congress levies tariffs on all imported Chinese goods. Patient negotiations with China have failed year after year. Millions of Americans have lost their jobs because of China's currency manipulation. It's time to enforce trade laws to ensure a level playing field. The world needs trade that is not just free, but fair too.